Assalamualaikum trader, welcome back to Sardar FX.
In this video, I'll reveal a powerful liquidity strategy, and it's the exact strategy used by professional traders, yet I'm breaking it down so simple that anyone, even total beginners, can follow. So if you want to learn the strategy that professional traders actually use, this is it. Now, let's dive in. So, the strategy revolves around one key concept, liquidity. But what exactly is liquidity? In simple terms, they are areas where pending orders are placed in the market. Let's break this down with a practical example. Imagine you're looking at a chart and decided to place a buy order at a certain price level. What you're actually doing here is providing liquidity to the market at that price level. You're basically telling the market, hey, I'm willing to buy at this exact price. The same principle applies when you place a sell order. You're basically telling the market, hey, I'm willing to sell at this exact price, which also creates liquidity at that level. In most markets, liquidity is present at every price level because millions of traders are constantly placing orders at different prices. These could be retail traders, big banks, or financial institutions. So at any price point, there's always a market participant willing to buy, and there's always a market participant willing to sell. That's the whole concept of liquidity, and it's what makes the markets move every day. However, there are certain price levels where there's more liquidity than others. For example, let's say there's a support level on a chart where prices bounced off twice. As price approaches that level again, what do you think most traders will do when they see this setup? They'll expect another bounce. So they'll enter a long position right at the support and place their stop loss just below it. If they're more cautious, they might place it further down to avoid getting stopped out easily. Now, you've probably experienced this before. Instead of bouncing, price wicks through the support just enough to trigger the stop loss, only for it to reverse and come back higher. You're then left wondering why the setup failed. The reason this happens is because professional traders, the ones with a lot of capital, intentionally target the resting liquidity below that support. They know that a lot of retail traders are watching the same pattern and are placing stop losses in the same zone. This creates a lot of liquidity in that area. So by taking those stop losses out, they absorb the liquidity needed to fill their own long positions. That's why you often see price wicking through a key level before reversing. And so, I'm going to teach you how to be in the 1% of traders who takes advantage of this, so you don't end up like the 99% who gets stopped out. And just so you know, this strategy works best on lower time frames, like the 5 to 15 minute chart, and it can be used on any asset, whether it's Forex, crypto, or stocks. Let's begin. So first, to simplify everything, I'm going to break down the strategy into 4 simple steps that you can follow. Keep in mind that all of these steps are connected to one another, meaning if you skip any of them, you can't proceed to the next one. So let's begin. Step 1 is identifying something called a break of structure in price. To do this, we first need to understand how trends actually form. So we all know there are 2 types of trends in the market, uptrends and downtrends. Let's take an uptrend, for example. During an uptrend, the markets rarely move straight up. Instead, it moves in a structured way, forming what's called higher highs and higher lows. On the flip side, during a downtrend, the structure you'll find is price forming lower highs and lower lows. Now, in an uptrend structure, whenever the previous high gets broken and price forms a new higher high, that's what we call a break of structure. Similarly, in a downtrend, whenever the previous low gets broken and price forms a new lower low, that's also called a break of structure. Now that you have an idea of what a break of structure is, let's look at a real chart example. In this chart, we can see that price is forming higher highs and higher lows, indicating an uptrend. To find the break of structure, we simply look at the moment price broke above the previous highs and formed higher highs, which is right here. So this becomes our break of structure. Now, it's important that you wait for a candle to actually close above the previous highs for it to count as a break of structure. So wicks alone don't count. Once a break of structure is identified, we can move on to step 2, which is identifying a supply or demand zone. These are areas where large buy or sell orders were placed in the market, causing a sharp move in price. The easiest way to find these zones is to first spot a break of structure. Then, look at the starting point before the sharp price move, which led to that break of structure. The area right before the sharp move upwards is called a demand zone. Similarly, in a downtrend, the area right before the sharp drop that led to that break of structure is called a supply zone. Returning to our original example, since we've already identified a break of structure, finding the demand zone becomes easier. We look at the area right before the sharp move that led to that break of structure. In this case, price began its sharp move upwards at this point. To mark the demand zone, highlight the last candle right before that sharp move. Use the rectangle tool to draw a zone from the candle's low to its high. This marked area becomes our demand zone. Now that we've identified a demand zone, we move on to step 3, which is finding a liquidity level. And this is the most important step in the entire strategy. To put it simply, liquidity levels are areas where a lot of stop loss orders are placed. Examples of liquidity levels are double bottoms, triple bottoms, or even multiple rejections from the same level. The point is, when a level looks too obvious for a bounce, a lot of traders enter long positions there and usually place their stop losses just below it. This causes a buildup of liquidity under that level, which becomes a target for stop hunts. So what we're trying to find is any type of liquidity level that's located above our demand zone. What usually happens is that price will break below that level, sweeps the liquidity below it, and then bounces off our demand zone. This bounce becomes our long opportunity. The same logic applies in a bearish structure. What we're looking for is a liquidity level that's located below our supply zone. What usually happens is that price will break above that level, sweeps the liquidity above it, and then rejects off the supply zone. And that rejection becomes our short opportunity. Now back to our original example. Since we've already marked our demand zone, the next step is to find a liquidity level sitting above it. And here, we can see that price formed a double bottom, rejecting the same level twice, which creates a pool of liquidity below that level. Once a liquidity level is identified, we move on to the final step, which is entering the trade. Entering the trade with this strategy is simple. We place a limit buy order on top of the demand zone, place a stop loss slightly below the zone, and set a take profit at 2 times your stop loss distance. Or if you want to be more aggressive, you can target the previous highs as your take profit. Now, a limit order means you're not entering the trade at the current price. Instead, you're entering at your desired entry price, along with your stop loss and take profit targets. This way, you don't have to sit in front of your charts all day waiting for the entry. Simply set a limit order and let the price move. In this example, price actually broke below the liquidity level, wicks into our entry, and then reverses back up, hitting our take profit target. Now, this strategy might seem hard at first, as many conditions need to come together for it to work, but it's really just about spotting a few key rules. A liquidity level formed near a supply or demand zone. It's no different than trying to spot a regular chart pattern. For example, in a triangle pattern, you're not trying to find this exact price movement, because price don't move like this in a real chart. Instead, you're focusing on the rules that make up the pattern, which in this case are the converging trend lines. It's the same with our liquidity strategy. Don't try to find this exact price movement on a chart. Instead, focus on the key rules that make up the pattern, a liquidity level that formed near a supply or demand zone. That's why it's important to understand these rules, and not just memorizing the price sequence. Now let's look at another example. So again, the first step is to find a break of structure. Looking at this overall chart, we can see that price is forming lower highs and lower lows, showing a clear downtrend. And right here, we can spot a break of structure as price broke below this low and formed a new lower low. We can also spot another break of structure here as price broke the previous low. Once the break of structure is identified, we can move on to step 2, which is identifying a supply or demand zone. Since this is a downtrend, we'll be looking for a supply zone. To do that, we take the most recent break of structure. Then, look at the starting point right before the sharp move down that led to that break of structure. In this case, it's right here. So we mark our supply zone. Next, we move on to step 3, which is finding a liquidity level below that supply zone. Here, we can see multiple wicks rejecting this level, making it an area of liquidity. This makes it a target for a liquidity sweep. So we now have a supply level with a liquidity level sitting right below it, making this a valid liquidity pattern. Now we can move on to step 4, the final step, which is entering the trade. Since this is a downtrend, we're looking to short the market, meaning we make a profit if price goes down. For the entry, place a limit short order at the bottom of the supply zone, set a stop loss slightly above it, and set a take profit target at the previous lows. Then simply let the trade run. In this example, price sweeps the liquidity level, hits our entry at the supply zone, and then rejects downward toward our take profit. So this is one of the most powerful strategies you can learn, and it's the exact same one that helped me earn $500 per day just by finding this one setup daily on lower time frames, like the 5 or 15-minute chart. The best part? It works on any asset. Sometimes I use it on Forex, crypto, or the stock market. Now, the liquidity setup I just showed you is only the basic version of the strategy. There's also a more advanced setup, and knowing this can help you even more if your goal is to achieve $500 per day. So let's dive into that right now. The way this setup works is, first, just like in the basic version, we start by identifying a break of structure. This allows us to mark a supply or demand zone by looking at the initial sharp move that led to the break. The key difference in this advanced setup lies in the liquidity level. Instead of being a typical rejection pattern, like a double bottom or triple bottom, the liquidity is formed by another demand zone instead, created from a second break of structure. However, this second zone must be a minor demand zone, slightly different from the major zone found below it. So, how do we know whether a supply or demand zone is considered major or minor? Simple. We look at the break of structure that formed after. If the break came from a large, obvious price swing, it's a major zone. If it came from a small, short-term move, it's a minor zone. For this strategy, the ideal setup is when we have a minor demand zone sitting just above a major demand zone. That minor zone becomes our liquidity level, and we look to enter a long trade once price sweeps the liquidity off that minor zone and bounces off the major zone right below it. So let's look at an example. In this chart, we can see that price is forming higher highs and higher lows, clearly in an uptrend. Right here, we see a break of structure, which means we can draw our demand zone at the initial move before that break, which is right here. Now, if we look closer, we can also spot another break of structure just above, meaning we can draw another demand zone before the initial move that led to that break. Since that break came from a small price swing, we classify the zone as a minor demand zone. Meanwhile, the zone below was formed from a large price swing, which makes it a major demand zone. So now we have our ideal setup, a minor demand zone sitting just above a major one, giving us a valid liquidity setup. For the entry, we place a limit long order at the top of the major demand zone, a stop loss slightly below it, and a take profit target at the previous highs. In this case, we can see that price rejected a few times at the minor demand zone before breaking it, retested the major demand zone which triggers our entry, and then bouncing up to hit our take profit. A clean and successful trade. So let's look at another example. In this chart, we can see that price is forming lower highs and lower lows, clearly showing a downtrend structure. There are also multiple break of structures that could be identified, but we'll focus on the most recent one, which is right here. From that break, we take the initial move that led to it and draw our supply zone. Looking closer, we can also spot another break of structure that came from a smaller price swing. This lets us draw a second supply zone, and since it was formed from a smaller move, we classify it as a minor supply zone. In contrast, the zone above was formed from a larger price swing, which makes it a major supply zone. At this point, we now have a minor supply zone sitting just below a major supply zone, giving us a valid liquidity setup. So for the entry, we place a limit sell order at the bottom of the major supply zone, set a stop loss slightly above, and target the previous lows for take profit. As we let the price play out, we can see that it showed rejection towards this minor supply zone, further confirming that this is a strong liquidity level, breaks through it sweeping the liquidity, hits our entry at the major zone, and then drops toward our take profit. Another clean and profitable trade.
जिन्होंने अब तक अकाउंट क्रिएट नहीं किया, नीचे डिस्क्रिप्शन में लिंक है, HFM ब्रोकर, एक्सएस ब्रोकर, उन साथ अकाउंट क्रिएट कर लें और फ्री गोल्ड और फॉरेक्स सिग्नल के लिए डिस्क्रिप्शन में लिंक है व्हाट्सएप ग्रुप का, उसको भी ज्वाइन कर लें। मिलते हैं नेक्स्ट वीडियो में। अल्लाह हाफिज़।